Hello, this is Doug Gerlach from ICLUBcentral. Welcome to our Lunchtime Stock Club webinar. Today is Monday, February 13th, 2017. Glad you could join us today. We're going to be taking a look at the state of the market as we usually do. We'll hear some words of wisdom from some of the great investing minds, and then we'll wrap up with a mini tutorial on another concept related to growth stock investing that you may already be familiar with, but perhaps if you're not, it's something you might want to consider integrating into your stock analysis skill set. As we always do, we're going to cover the basics first. For technical problems, please go ahead and contact GoToWebinar.com directly at their website or via their toll-free number. It won't help you to type in the chat screen if you're having technical problems because we have no one here who can assist you. But with your technical issues, please go ahead and contact GoToWebinar. If you can't hear me at any point during the program, or if the sound or graphics are choppy, we suggest that you turn off any unnecessary programs, especially those that are running in the background on your computer. Don't connect using Wi-Fi, and you can always listen using the telephone, which will free up your computer to deliver the video component of our presentation. The handout is in the PDF format there in the Handouts tab. You can grab it right now. We'll make it available when we archive the webinar as well. But you can quickly print that out if you like and save it for future reference. Just look for the Handouts tab in the GoToWebinar application. Now, our schedule of upcoming webinars is there on iClub.com. Do note that in March there will be no Lunchtime Stock Club because of my travel schedule, but we'll be back in April. Our Investment Club webinar series continues next Tuesday. Next Tuesday, February 21st, with our Club Tax Clinic. That's where treasurers can bring their specific tax issues, and our team will be on hand to help address them during the webinar. Our next Toolkit webinar, Tuesday, March 7th, and we also have a special webinar for subscribers to the Investor Advisory Service next Wednesday, February 22nd at 1:30 p.m. Eastern Time. We've got Scott Horsberg joining us this time for an update on the markets, look at the economy and the current outlook for the rest of 2017, as well as talk about some of the stocks that we've been covering in the Investor Advisory Service newsletter. If you are a subscriber, you can find that link on the IAS website. Look in the February issue. Or also check the emails that we've sent with the registration link with some of the recent stock alerts that we've sent out, as well as a special email that we sent about 2 weeks ago notifying all subscribers about that. If you're not a subscriber, of course, we'd love to have you, but you can access the fourth quarter subscriber update that we did in November on YouTube. We do have a YouTube channel, and so you can view it there. We will embargo those subscriber webinars for a period of time before releasing them to the general public. But if you want to hear the smart minds who are behind the Investor Advisory Service stock picks like Scott Horsberg and Dan Boyle and Miles Putnam, they'll be joining us for this quarterly subscriber series, and you'll be able to follow along and hear some of their outlook on the market and the economies in those webinars. So check out YouTube, search for Investor Advisory Service or ICLUBcentral to find the link for that webinar archive. As always, on Facebook, you can find ICLUBcentral there, and we'll let you know updates to all of our products when they're released. During tax season, we have released an update today for 2 more of the state tax printers. So those are finalized now for Georgia and Indiana, bringing the total number of states for which we are officially authorized to offer Club Tax Printer modules to 7. So we've got 7 more to go. We're working hard on getting those necessary approvals so that we can release those. Reminder, this year the Club tax filing deadline has been moved to March 15th from April 15th, so clubs have a month less to get their tax returns to the IRS and to many of the states, although not all of them have changed that deadline for partnership returns. So the This month, where we stand, so we are 6 weeks into 2017. There's been a lot going on in the market, but as always, we like to look at the numbers. So here we are, year to date, the market performance for the 3 market segments that I like to track. The magenta on top is the big winner so far this year. This is the Morgan Stanley EFA index, the Europe, Australasia, Far East index, and that is up 4.62%. This index represents the global developed country large cap markets. Instead of global, I should say international. So these are companies outside the United States. And they have been performing well, but they're coming off several years of weakness. But now a little bit of an uptick with that international segment of the large cap market. The blue is the S&P 500, so they up about 3.9% year to date, and the green at the bottom is the small cap Russell 2000, up 2.8%, but again coming off of a strong finish last year, recovering from a bear market, and then heading off into new highs as we see here in 2017. So even up from the little bump they got at the beginning of the year. So as always, markets, you see these markets showing a rare degree of correlation. They're all kind of climbing at the same rate as we head into the last half of February. The big story, I think, is that the S&P 500 PE ratio is flat for the month, and that's actually, I think that's a good sign. You can still see it's at a fairly elevated level relative to the history of the market at 26.11. Last month, it was 26.15. When we met at this Lunchtime Stock Club. So the PE ratio is essentially flat. And the reason that's a good sign is that earnings are actually up. You can see the earnings here at 89.09. Last month in January they were at 87.17, so we're about $2 up for earnings for the S&P 500. That was the same in December, so we're seeing a little bit of an uptick in the S&P 500 earnings. So as companies have been reporting for the fourth quarter, we're seeing some strength there, and those numbers starting to recover for the first time in about a year and a half. We see a little uptick in the S&P 500 earnings, so that points to improving economic situation. Productivity is increasing. Companies are doing well. Certainly the improving global outlook is helping some of the companies with their exports and their non-U.S. portions of their businesses. And you know, we still have a long way to go to see a market that supports that PE ratio of 26. But the fact that earnings are going up, and that's going to support that high PE ratio for the overall market. As I've talked about before, there are lots of reasons for that high PE ratio. Many investors are fleeing fixed income investments, fleeing the bond market, fleeing CDs and cash deposits, and looking for yield out of the market. The only place they see that they can get an acceptable yield. So even the typically risk-averse investors kind of throwing their money into the equity market. And so demand, when there's demand and there's a limited supply, then the price goes up. And so that's what we're seeing right now. The prices continuing to go up. But as I said, I think this is we've been waiting for this turnaround in S&P 500 earnings as we go along. When I look back, the earnings have been declining pretty steadily since April of 2016. And then before that, when we started tracking this at the beginning of January, the S&P 500 trailing 12-month earnings were over $94. So we've still seeing a slight decline. Energy stocks obviously have driven down earnings because many of the large cap energy companies have had some serious profitability issues in the last couple of years, and that's pushed down that sector, and it's hurt the S&P 500 performance. So that's where we stand going into February. Things are perhaps looking better than they have in some time, even if it's just slight. for the overall economy and the overall markets. But of course, we're only buying individual equities. We're buying quality companies at reasonable prices in any market. Our hope is that as if the PE ratio stabilizes and comes down a little bit, it'll make it a little easier for us to find those stocks that we like at prices that we consider affordable. And that's been the big struggle for most of 2016, I think, and continues into 2017. We can find great companies, but they're expensive, and we just don't want to pay over full price if we can help it. So we continue to try to identify those reasonably valued equities for our portfolios. So this month, let's talk about some words of wisdom, this time turning to Benjamin Graham. Benjamin Graham, as students of the market should be aware, was a professor at Columbia University. Following the Great Depression, he put together a textbook looking at the causes and looking at ways that analysts should be considering equities in the market. The book, called Security Analysis, is the Bible of many stock investors. One of his students, Warren Buffett, of course you're aware of, but Warren learned much from Benjamin Graham, and has integrated many of the concepts that Graham pioneered. Another book that Graham wrote, The Intelligent Investor, has some additional insights, and one of them has to do with something that's very close to the stock selection guide. That is the concept of evaluating management. And as Graham wrote, the most convincing proof of superior management lies in a superior comparative record over time. And then later he wrote, if you don't like the management, sell your stock. I think that kind of ties up our approach on the stock selection guide. Often we get hung up on looking at the numbers, how fast has growth been in the past. Is earnings growing at 15%, or sales growing at 15%? And we forget that what we're really looking for is evidence that management's doing the job. A manager's job in a publicly traded company is to deliver return to shareholders. At least that's what it should be. So we want to find evidence that management is capable of doing that, and ideally is doing it at a better rate, at a higher level than managers of other companies, their peers and competitors. And so the SSG is our tool for evaluating management, and we need to remember that it is the management that makes the difference. Another thing that Graham wrote has to do with volatility. And he wrote that intelligent investment is more a matter of mental approach than it is of technique. A sound mental approach towards stock fluctuations is the touchstone of all successful investment under present-day conditions. And I think those conditions remain the same. At the Money Show in Orlando this past weekend, I was explaining our concept of how we choose stocks for our portfolio, how we hold through bear markets and market downturns, how we're not spooked by the news reports that are meant to frighten other investors out of the market, the talking heads on TV who tell us it's time to move to sidelines, and that for us, risk management means understanding the risk and knowing that when markets decline, that it's only temporary, and bear markets end and market downturns turn into upturns, and that rather than trying to time the market, trying to find those immediate exit and entry points that maximize our returns, we recognize that being out of the market on just a couple of its best days can deteriorate, cause your returns to deteriorate significantly. And instead of trying to identify when those days are, it's just much better to hold through periods of downturn. And this investor that I was explaining this to simply said, I can't hold during bear markets. He just didn't feel like it was a sound approach, and so our approach just wasn't going to fit with all that he knew or thought he knew about investing. And that is often the case. investors have been trained in the U.S. to listen to third parties that are providing advice that benefits those third parties. It doesn't necessarily benefit the individual portfolio. When you hear money managers on TV making calls about the future of the market, we don't always get the track record of how many times they've made those same calls and been incorrect. But if they are correct just once and get picked up in the media, it can make all the difference in the world to their reputation, and customers will believe that they've got some sort of insight. Our insight is that that kind of particular market direction insight is impossible to come by. You know, we don't even really allow for it. There are so many moving parts that cause the market and the economy to move in individual directions. We can predict with confidence that there will be a bear market for the U.S. equity market at some point down the road, but we just don't know when, and so we're not going to make plans for it. So I think having the right mental attitude, as Graham points out, is something that we don't talk about or think about as much. Certainly an educated investor is the best kind of investor from our approach. Having a solid outlook and framework and having confidence in your ability and understanding how the market works will go a long way towards helping you to be most successful in your investment portfolio. So those are some words today from Benjamin Graham, one of the great minds of the financial markets. So we're going to bow down to Graham and try to keep his words of wisdom, take them to heart as we develop our personal investing approach. Now let's talk about the educational portion of our webinar today. I wanted to talk about the implied growth rate. The implied growth rate, it's something that we've integrated into our Toolkit 6 approach. It's something that we've talked about, that we've seen in the Better Investing publications. I learned about the implied growth rate from Ralph Seeger in the stock studies that he used to produce for the Better Investing Bits publication. And again, going back 25 years when there was a separate newsletter that focused on computerized investing and Toolkit and the other programs, and Ralph would frequently write a stock study where he would include judgment and his thinking about the particular company that he was studying. And one of the concepts that he used on a regular basis was the implied growth rate. In version 6, we brought the implied growth rate into Toolkit on the earnings per share projection entry screen, the judgment screen where you enter your sales and earnings growth rates. So here on the screen at the top, you'll see where you have the ability to estimate where you input your estimated sales growth, your estimated earnings growth rate. We bring in the analyst growth rate from the data service. The next item is the take stock earnings growth rate. For YTD subscribers, we have an algorithm that calculates earnings per share growth rates on the projected basis based on the most recent earnings per share growth as well as the historical growth, and we have some rules that we apply to try to come up with what we think is a reasonable growth projection, capping it at 20%. And then finally down below is the implied earnings per share growth rate estimate. And that's what we're going to talk about today, the implied growth rate. What is it? How can we use it? Is it correct? Is it something that we can use? So let's talk about implied growth and how it can be incorporated. So what is it? Well, it actually has many names and they all refer to the same concept. You may hear not implied growth but implicit growth rate or internal growth rate, or also the sustainable growth rate. Sustainable growth, I think, is probably the next most common description of this concept. Value Line calls this the rate of retained earnings to common equity. So this is can be found on any Value Line report. So if you search on it for the rate of return of retained earnings to common equity, you will find the value that we're talking about. And it's also known as the plowback ratio. as you might gather from some of these, what we're looking for is how well the company uses the resources at its disposal to reinvest in the business and generate growth of the business. So the plowback ratio, we're plowing back earnings into the company's business. Retained earnings, what's left over after dividends, what's the rate of return of those retained earnings on an annual basis. But let's look at the actual calculation. The formula, we take the average return on equity, and again, you can tweak that up and use the most recent year return on equity, but in Toolkit, we're looking at the average return on equity. We multiply that by 1 minus the dividend payout ratio. So in other words, we're looking at what's in effect the non-dividend payout ratio, and then that gives us the implied growth rate. You look at what we're doing here. Well, we'll talk through it in just a minute. But if you notice right away, companies that don't pay dividends, the implied growth rate is equal to its return on equity. So that makes it very easy if you're looking at a stock selection guide on paper and you want to know what the implied growth rate is. If they don't pay dividends, it's equal to their return on equity in section 2B of the SSG. So here's how we get to this value. Here's how we interpret it. We're thinking about ways that companies use assets to drive growth. They use the equity that they have on hand. That equity grows every year as the company has profits. They plow back into the business. So we start with equity at the beginning of the year, the total value of the club's equity, all of the money that's been invested into the business up to that point. So management uses all of those resources, the equity that they've used to purchase materials and raw materials, facilities, labor, etc. And on an annual basis, that equity base generates a return that we measure by looking at the net profit. So we have the net profit, that's the income after taxes that the company has in an annual basis. So if we know how much of an investment they've made in the total operation of that business to date, we can see on an annual basis how much of a return they generate, how much in profits they generate using that invested base. Now, if the company pays dividends, that money has to come out because that money is no longer can be reinvested into the company's business. So we take out the dividends, and then finally what's left is what we have, the net profit that gets retained by the company, gets reinvested in the business. It becomes part of the equity plus retained earnings, and so we have a new equity value at the end of the year, and so we calculate this return on equity. So that's the concept why we look at return on equity. We're trying to figure out how well the company is delivering a return based on all of the assets that they've invested in the business to date. So on a pragmatic level, we can look at the implied growth rate as the theoretical limit of a company's organically generated growth. It is the maximum that a company can increase their earnings on an annual basis based on the equity that they have available. And that will vary by industry, vary by sector, of course. So you can use this to double check your earnings growth rate. In Toolkit, the idea by showing it on that screen is that if the implied growth rate is below your earnings per share projection, the number you're about to type into that box, then you need to do a double check. You need to perhaps reconsider. There are times and ways that growth may be faster than the implied growth rate. But those, again, depend on your understanding of what's going on with the business. Now, if the actual growth is less than the implied growth, this is from Robert Higgins, who has written on the concept of sustainable growth. When actual growth is less than the sustainable growth rate, management's principal financial challenge is finding productive uses for the excess cash flow. Options are to increase dividends, repurchase common shares, reduce liabilities, increase assets, or buy growth. That is, acquire other companies for their growth potential. So if the company is growing below the sustainable growth rate, it means that they've got lots of money left over, potentially, that they're not finding an optimal use for. And sitting on money in the bank is not a way to increase the value of their business, especially when bank interest rates are so low. Maybe they're building up a war chest, but ultimately they need to do one of these things: buy back shares, increase dividends, make acquisitions, reduce liabilities, or increase assets. So they need to take care of their business if they want to continue growing at that, their maximum potential. If the growth rate of earnings is faster than the implied growth rate, Higgins writes, when this actual growth rate exceeds the sustainable for an extended period, management must formulate a financial strategy from among the following options: sell new equity, that means issuing more shares; permanently increase financial leverage, that means taking on debt; reducing dividends; liquidate marginal operations; outsource activities; cut growth by increasing prices; or find a merger partner with deep pockets. So if the growth rate is faster than the sustainable growth rate, that could be a clue that the company is engaging in leverage, that they are borrowing money, and that borrowed money is allowing them to generate growth that's faster than they would otherwise be able to do. Now, if they're borrowing money and they're not able to generate additional growth, the question has to be, why are they borrowing money if it's not actually contributing to the bottom line? And so it can be part of a clue in your analysis of what you might want to understand if there's a big disparity between the actual growth rate and the sustainable growth rate, again, over time. In Toolkit, we're taking a snapshot as of the average the last 5 years. In some cases, that might not be as appropriate if there's a big change in the return on equity that the company has been delivering in recent years. If it's trending up or trending down, the average may not be as relevant, but it gives us a starting point for our analysis. In Toolkit and other tools, you can find, as I said, here on the left, the judgment window for sales and earnings has that implied growth rate. On StockCentral, we actually included here in the implied growth rate in the key ratio section. We've got some other ratios that don't show up in very many places, but the implied growth rate is there. And interestingly, in My Stock Prospector, the implied growth rate is a screenable field. So you can actually build a screen that looks for companies that have an implied growth rate, and again, I set it at a 7% floor here, because I want companies that have a maximum growth rate of at least 7%, as demonstrated. And then over here, you can't see the extent of this field, but I have the industry average of the historical 5-year earnings growth. So that means that the implied growth rate has to be faster than the 5-year earnings per share growth rate, right? Because I don't want the implied growth rate to be below the maximum, but below the earnings growth rate. I want to see earnings growth. I want to see earnings growth that's in this case. Let's see. So implied growth rate between. So implied growth rate is going to be above the earnings growth rate, right? Yeah. So this is our My Stock Prospector growth field, so you can actually take a look at that. If we look at the screen in My Stock Prospector, we can see a number of companies that show up as we look at it. I've excluded the junk companies and industries from showing up on our screen. And as we sort this, we can sort it by a number of fields. I'll go ahead and sort it by fastest earnings growth. So we can take a look at companies that are at the top of their growth field. So let me just exclude industries there again. All right, so we have the ability to use the implied growth rate here. We can actually search for companies with high sustainable growth rates and then whittle down from there. Certainly Berkshire Hathaway would show up on this because we know that Warren likes to look at return on equity and puts a lot of stock on it. So this is, again, a way of getting at some ideas using that implied growth rate concept. It's something that is very easy to start implementing in your stock studies using the core SSG or the SSG Plus. I built a little spreadsheet at one point that helps with this calculation. So if you need to, you can do something similar with that formula, plug in and get access to what that sustainable growth rate would be for any company that you might be looking at. So hopefully that's something that you can use like to in your analysis. We'll certainly look at happy to look at some other stocks as we're considering them. If you have some ideas or things that you want to take a look at, please let me know. I was using for my example for the for sustainable growth, I was looking at Ulta, which is a company that's been showing up on our Ulta Beauty, the chain of specialty retail cosmetic stores, and they just have a great looking SSG. You look at the graph here, sales and earnings, pre-tax profits moving along, quarterly basis moving along really well. We've got a 20-year annualized sales growth rate. We've got a 36% annualized earnings growth rate. We've got a little bit of a fall off in 2008, 2009. Again, this is not, regardless of what you may hear from some women, you may hear that that cosmetics are an essential purchase, but judging by the recession, there is a slight drop-off. If people are pressed, they may not be as eager to stock up on cosmetics, or they may shift into less expensive cosmetics. So you see a little bit of a drop-off during a recession. Earnings actually went down, growth went down in 2008, but it promptly recovered in 2009. So it was a very mild effect of the recession. Sales continued to increase. Again, as you look at this, you can make some judgments about what was going on during this recessionary period in 2008, 2009. Sales growth, the growth rate, if you zoom in, you can see that the growth fell below the red trend line in that period, just ever so slightly. But you can see that profits were flat, earnings went down in 2008. So the company probably was engaging in some price cuttings, running sales promotions, which ate into their margins, but then they were able to recover pretty quickly. So I've always liked the fundamentals of the company. The problem with the company is that so let's go ahead and just plug in 20% growth. We've got analysts looking at 21% growth on average over the next 5 years. The implied growth rate is 28%, so it looks like they've got a couple more years where they can be supporting that 20% growth. So I'll be aggressive and give them the benefit of the doubt at this point and say, okay, let's see if we can continue growing at 20%. I guess if we check the historical growth rate, we can definitely see the last 4, 5, 6, 1, 2, 3, 4 years, growth has still been in that 21%. So it hasn't really been, sales growth has been still chugging right along. Look at that every year above 20% on an annual basis as we add periods there. Our earnings growth slowing a little bit, but seems to have stabilized in that 23 to 25% range. So maybe 20% is doable. We flip over to the back. We can see margins. We just love this trend. A little bit of downturn in 2008 as we talked about, so a little margin pressure, but then quick recovery coming out as they expand the number of locations and build up more of a brand name, build up their audience base. You can see margins reaching an all-time high last year. So that is definitely a positive sign, a trend that we like to see. Return on equity, again, not too concerned about this trend falling off a little bit there. That's still a superior 28, 26% return on equity. So that is pretty solid. No debt to speak of, which again is pretty phenomenal. But the problem as we look at the PE ratios is that you're paying a lot for that growth. On the high end, PEs in the high 30s. On the low side, PEs dipping down to maybe 20, but in the mid 20s quite often on the lowest possible opportunity there. So in the 52 weeks, in the last 52 weeks, the low PE has been 24, the high PE has been 46, and the current PE is 45. So there are very few people who are unaware of Ulta's great growth story, and that just makes it a very expensive stock. If we did kind of an analysis here, I'll use my rule of thumb, 1.5 times the growth rate. So 20 is the growth rate, 1.5 times that is 30 as the maximum PE. And on the low side, you know, gosh, it hasn't been below 20. Well, it's been to 19 again in 2011. I'm going to say, you know, growth slows to 20%. We'll go ahead and put in 15. Again, on the premise that in 5 years, as the growth rate slows down to only 20%, and there will be some investors who will be upset about the deterioration of earnings growth. A low PE of 15 would be reasonable, I would think, but it wouldn't be, you know, but the chances are that it would get there, barring any sort of calamitous event, are probably pretty slim. Now, during if we had a market correction, you can see that the price fall and a little bit of a pullback in the P ratio. So this is just my thought process as I think it through. I'm not at all committed to 15. We'll use the last 4 quarters earnings of 596. That gives us a low price of 89. As I look at the other options here, they've been as low as 82 in the last 2 years. The average low price, 77. 80% of the current price is 215. Currently, they're selling at $270. So that forecast low price is really, really, really low. I'd kind of be hesitant to use the 80%, you know, accommodating a 20% drop off, but. So that's the big debate. I'll go ahead and use the price variant quotient. Just again, this is the average distance between the high and the low prices. So that gives us a low price of 168, which the company did trade at in 2015. This year, oh yeah, they've been as low as 146. So they haven't actually been that low. But even at that point, it's still a hold at a 1.7. Upside downside ratio and a 10.5% annual total return. So that's what you get from a high quality, fast growing company, just not a lot of opportunities to buy it. My buy price in this scenario would be up to 237. So that would be about a $30 drop in price from the current price. And if that happened, we'd want to understand why. But that's Ulta. Again, I've looked at that company in the past, and it's just never been reasonably priced enough for me to kind of consider. A little bit bigger than a small cap now, with sales at 3.9 billion. So that's what we would consider to be a mid-sized company in the better investing nomenclature. But look at it, sales in the last quarter up 24%, earnings up 26%. We'll be waiting for their fourth quarter 2016 final numbers, but you see they had 3 strong quarters going forward as you go there. Jay's saying, why are the 2016 results not showing a new chart? Their fiscal year ends January 31st, so we're only 2 weeks into the fiscal year, so I don't think we have 2016 results yet. So we'll expect, as I would expect to see those pretty soon in the next 2 to 4 weeks. I don't know the schedule. I don't follow the company other than to know that it's been a very expensive company, very, very expensive stock. Roy asked about Gentex and LKQ. Gentex was recommended recently in the, let me update, in the Investor Advisory Service. So this is my analysis, so this is not the same analysis of the IS analysts. The fourth quarter earnings were flat. And again, we don't know, I don't know offhand if there's any adjustment to them. Sales were up 3.5%. You see if we look at the numbers here. I'll go ahead and let's set to values so we can see where things are. This is why we kind of like this business. You can see a little bit of a decline in 2008, 2009 during the recession when car makers were not selling a lot of cars during that recession. Lots of other things going on with the market. Gentex makes heated automobile mirrors. That's kind of the big driver of their business, but now into backup cameras and other connected automobile electronics and technology. There's a movement in the U.S. towards requiring all cars to have backup cameras. So some companies like Honda have already implemented those across their line. Other car makers are still lagging a little bit. There was a movement in place to get all the car makers to switch over to incorporating backup cameras as stock on new vehicles, and I think there was a little bit of a snag in the implementation of that, but it just drives Gentex's business as they are going forward. If we look, so my growth rate's here, 10%. The sustainable growth rate, you'll see the implied growth rate, 9.7%, so just a little bit above that, but that's what analysts are also looking at, that 9.7% growth rate. If we, I'll go back and let's go ahead and let's look at some analyst estimates just to get a sense of where the rest of the market is looking for this company. So $1.31 for the current year and $1.45 for next year. So I'll go ahead and plug those in, 131 and 145. I hope I remembered it right. And the sales, 1.82 and 1.96. So 1.82, 1.96. So you can see, yeah, that's pretty much 10% growth coming out of Gentex. Kind of fits with what the analysts are looking at. Profits, you can see here the strength of the profit margins. So we're doing very well. As the company has grown, those margins continue to increase and now above 30%. You see the fall off in 2008 during the recession from the high 20s going into the recession. So we see the recovery and then in 2013, 14, 15 just continuing to edge upward, which is a really strong sign. Debt going down. So the company is well capitalized, doesn't need debt. They are making some acquisitions, I think, so that's why they're using the debt, but then they're paying it down pretty aggressively. It's below 10% debt to equity right now, and the return on equity also very strong, post 20%. As we continue to scroll down, current price $20, so you can see that's near a 52-week high for the company. 22 is the high, 21.89. There is the 52-week high price. Current PE 16.9, so not exceptionally expensive. A little pricey for a stock that's growing at 10%. You see on the low PE tends to be in the 10 to 12 range. The high PE tends to be, has been declining. So I think 16.9 is probably just above the average historically. I would not, I think the fact that the company has been selling at 17 into the low 18s on the highest PE side gives us a little bit of an indication that the new reality is probably something in the 17 PE range. And on the low side, on the 10 to 11, I'll go ahead and put in 11 just to give them a little bit of benefit of a doubt there. And then the trailing 12-month earnings at $1.21 gives you a low price of 13, which is their 52-week low price, very close to that. And so if we use those values, we're in the hold zone. Payout ratio, we'll use the average of 34%, gives you another 2% in yield. So again, looks to be, to me, looks to be fairly valued right now. Not the biggest return candidate. If you are a little more aggressive with that low price selection and say, we'll take a 20% haircut and use that as a low price, that 80% price, then it's right at the buy zone. But again, your total return is just under 12%, so it's a little conservative, a little below our objectives. Again, that's just my back of the envelope analysis of Gentex. Like the company a lot, would not be much of a buyer until the price got a little bit more below, a little bit lower than $20. I think they've reported their fourth quarter earnings, so those are incorporated there. And again, the fact that the earnings were flat, if they're if they've had some one-time adjustments there, I might want to, that might bump up our base a little bit and give us a little more margin in the company. Again, I know that we covered it in the IAS in the last month or two as a recommendation, but I don't know what the price was at that time. Joe says, what about ALB's future? Well, let's take a look at ALB. So specialty chemical company, Albemarle, trades on the New York Stock Exchange, basic materials sector, and if that's the company you're talking about, again, specialty chemicals, basic materials, we often see some cyclicality there. When the recession, when we have a recession, companies are not manufacturing as much, and so the providers of raw materials like this company will see their sales decline. So again, that's what we're focusing on. What we're seeing in over here, 2008, 2009, we see earnings and sales actually declining. Not, we're not falling off the map like some companies do, but there's definitely a cyclical nature to it, a little more pronounced than we saw with Gentex or Ulta, which are also sensitive to the economy. We see. Let's go ahead and open it up here. Yeah, here's a great kind of a great learning opportunities. We're looking at sales, and we're looking at earnings, and we're looking at profits. We see that sales are going down while earnings and profits are going up. We actually see from 2014 to 2015, profits going up faster than earnings. But we also see the number of shares outstanding going up. So the company's not buying back shares. Looks like they issued shares. So they may be looking at some capital needs there that cause the number of shares outstanding to grow so significantly. And then, yeah, and you see their debt levels climbing as well. So I want to understand what's going on with the company's debt. I want to understand what's going on with their margins and sales that are declining. Looks like they might have had a one-time event last year, and they're just regressing to the mean, but doesn't have the great growth profile that I like to see. Margins definitely having pressure. I would consider that a downward trend, so I want to know about that. Debt's increasing, debt to equity ratio increasing, so that's, again, want to understand it, but it's not, you can't call it a positive right out of the back. So looks like it's at a 52-week, close to its 52-week high price right now. So it's relatively expensive, but it's hard to make a growth projection for it based on this particular company there. Dicom Industries, asks Judy. This is one that we had covered in our small cap informer, and we dropped it, and maybe it was not the right decision because they've continued to perform pretty well. So again, what do we think for sales and earnings growth rate? Analysts are not looking at a lot of it, but this is, again, a highly cyclical industry and company. So I'll plug in 10% just to be on the aggressive side. Again, what's the impact during a recession? We see over here, we see, sales falling off. We see profits and earnings really falling off the chart here, and then recoveries. So we just need to take that into account, that this is not a company that when we have the next recession, we're not going to continue to see growth. $2.6 billion in sales right now. So that's my 10% growth expectation plotted in there. The margins going up, so that's great, but again, coming from weakness during the recession, so and a little bit of volatility there. Debt going up as well, so debt to equity is much higher than 100% at this point, 133% as of the last year. If we look at the PE ratios, we see they've been coming down a little bit. These are all, the 10-year history, these are all irrelevant to us. So somewhere in that, I think 29, I think 26 would be high. I'll say 22.5 just to be on the conservative side, and then maybe 10 or 11, 10 to 12 on the low side. Again, that's out of whack. Yeah, so that gives us an average of around 11. And then, so forecast low price, we'll just stick with the 50. So that's giving us a 3-to-1 with a 16% total return. So, yeah, that's pretty reasonable with an aggressive and somewhat. Well, I was a little more aggressive with the growth rate at 10% than analyst estimates, which were below that. We flip back to the analyst estimates as brought in by the data feed. Analysts projecting growth at 7%. So we definitely want to know what's going on. They've got a second quarter, should be reporting. Well, that won't be until March, but they definitely had a bang out first quarter with sales up 21%, earnings up 74%. So, yeah, I wouldn't eliminate it from consideration. I would compare it to NV5 Global, ticker NVEE, which is another engineering construction company that we track in the small cap informer. I think that's probably a nice face off to look at those companies. Joe says that Albemarle, the ALB, that this company is says that they expect to be a major supplier of lithium, and so there might be some of the reason here for the upturn if demand is going in that market. So yeah, that could well be the case, but I'm not. This is a very all over the place historical trend, so it's hard for us to get a sense of the long-term viability of their business at this point. LKQ, Roy says, let me update the data here. Again, we track this in the Investor Advisory Service. They've had a little bit of softness. Third quarter reported end of September 30th, so we expect them to be reporting their fiscal year soon. But again, just a great trend, great growth story. Sales looking to grow, have been growing a little faster than earnings. Uh, shares outstanding haven't been changing that much. Um, uh, doesn't pay dividends, have a little bit of debt. They've been consolidating. LKQ is a provider of used and refurbed automobile parts to repair shops around the world. So they buy up junkers. They buy used vehicles, vehicles that have been in accidents, and then salvage parts off of them. One of the strengths is they have a massive database and computer network. So a repair shop can log in, see what part they need, see what the price is, get a shipping estimate, and it all comes out of LKQ's inventory database. So they've got locations around the country, and so it's been a great business. They've been performing really well. So it's a $7 billion a year product line. Even during recessions, they tend to be strong because during recessions, people postpone buying new vehicles and instead spend money on updating their used cars. So they actually get support there. And you can see in 2008, their sales actually went up. 2009, they were essentially flat, but when the recession ended, they had problems during the recession getting auto parts because used part of the federal program had used cars getting junked and the engines melted down. So it prevented LKQ from growing its inventory from the programs that were in place to get consumers to buy new vehicles. So nothing there that would be an alarm for me. Oops. If we look at the profit margins, this is, again, stable. Great example of stable margins. I think Toolkit calculates it's a slight downturn because we're looking at, percentages here, small percentages, but I think that's a pretty flat and even trend. Return on equity has been pretty stable for the last few years after kind of riding up and then coming back down. So based on was my growth rate, 15% growth. Analysts looking at 13% growth. I might ratchet these down a little bit just to compensate for the size of the business as they've continued to perform. So conservatively, 13%. You see the implied growth rate, 15.7%. So we'll say 13% just to again, leave a little margin of safety there. My high PE would probably be a little bit lower than 24 if that were the case, and the low PE a little bit lower than 17. It's been as low as 14.4, so I'll say 15 just to back of the envelope. Last 4 quarters earnings, $1.52, gives us a low price around 21, 22.8. So that puts it pretty in the buy zone. Total return is just below our expectation of our target of 15% at 14.6%. So again, in a universe of overvalued companies, here's a company that's pretty reasonably valued. Again, I don't know anything about if they pre-announced their earnings or anything, but the current PE at 20.5 is just above their calculated average of 21.8. And the projected PE ratio going forward is 18. So it could be definitely one to consider if you've looked at it in the past, or if you wanted to add to, if you know more about the news. Again, do your own research and do your own understanding there. Don says, do we have any President's Day sales going on? Yeah, we'll have a campaign going out at the end of the week with our President's Day offerings. Also, just check out our Ultra Bundle on the iClub website in the store. If you have existing products, you can consolidate their expiration dates and add in new products, and you can get discounts over the single-year rates as you add products and as you add up to 3 years to your subscription term. So it's great you don't have to worry about products expiring. So you'll find out more about that on iClub.com at our Ultra Bundle program in the store. Coming up in April, I'll be at the Northeast Ohio chapter doing a workshop for them. I hope to see many of you at the Better Investing National Conference in May in Cincinnati. In June, I'll be in Washington, D.C. at the II/Better Investing joint presentation. So I'll be giving some education content to their members of both organizations at that event on June 17th. And then my fall is quickly filling up with events in summer and fall, the Georgia chapter of Better Investing, the Portland chapter, the Puget Sound chapter, the Central Indiana chapter. So I've got a lot of educational opportunities on the road. Hope to see you at those as we go along. So thanks for joining us today. We'll look forward to seeing you not in March at our Lunchtime Stock Club, but we'll look forward to seeing you in April. And thanks again. I hope you're staying warm wherever you are, especially if you're in New England, where we have several feet of snow keeping us busy over the last couple of weeks. But hopefully I'll get to go out skiing maybe this weekend and take advantage of some of this winter weather. Thanks again. We'll see you next time.